Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. Market Analysis, TSLA, Now, MSFT Earnings, and Market Divergence. This video presents a direct informational narration of the source document. So, let's get right into it. We're looking at a market that's really in a strange state of flux right now. You've got these major tech earnings making huge waves, but the bigger picture, well, it seems unusually disconnected.
All right, here's the game plan. First, we're going to set the scene with this kind of weird market environment and what's happening on the geopolitical front. Then we'll dive straight into the earnings reports from Tesla and ServiceNow, which were, well, a real roller coaster. After that, we'll see how the whole software sector is doing, and we'll put Microsoft's big move under the microscope. We'll also take the pulse of a few other key tech stocks that are showing some serious momentum. And to wrap it all up, we'll try to make sense of this market divergence and what it could mean going forward.
Okay, so let's start with the big picture. As of April 22nd, 2026, the market is doing some really strange things. It honestly feels like the major asset classes are just living in their own separate universes, totally ignoring each other and just doing their own thing.
I mean, just look at this disconnect. You've got Brent crude oil trading over $100 a barrel. Now, usually that would be a huge red flag for stocks, right? It means higher costs for, well, everything. But what's actually happening? The S&P 500 and the NASDAQ are both rallying over 1%. And at the exact same time, the bond market is just kind of drifting. No clear direction at all. All of this is happening while we're getting these really mixed signals about US-Iran tensions, which just adds another layer of confusion to the whole thing.
Now for our first deep dive, Tesla. Man, this earnings report was a perfect example of a great headline followed by a really cautionary tale, and it caused the stock to swing like crazy in after-hours trading.
So on the surface, Tesla's quarter was fantastic, a total home run. They beat on revenue, they beat on earnings, they beat on gross margin. But the real showstopper, the number that got everyone's attention, was the free cash flow. Just think of free cash flow as the actual cash a company has left over after paying all the bills to run and grow the business. Analysts were bracing for Tesla to burn through nearly $2 billion, but instead, they generated over $1.4 billion in positive cash. Turns out, they just spent less than everyone thought they would in the first quarter.
But, and this is a big but, here's where the story just completely flipped. All that optimism from the report, it just vanished during the earnings call. That really impressive positive Q1 number got totally overshadowed when management said that actually free cash flow is going to be negative for the rest of 2026. This complete 180 is what sent the stock right back down.
So you're probably asking, why the sudden change of heart? Well, it all comes down to a massive increase in spending. Tesla announced they are cranking up their capital expenditure forecast for the year to a whopping $25 billion. That's a $5 billion jump from what they said before, and it all but guarantees they'll be burning cash for the next few quarters.
All right, next up, ServiceNow. This is such a great example of how a company's outlook, what they think is going to happen, can totally trump its current results. And it didn't just hit their own stock, it sent ripples across the entire software sector.
ServiceNow's first quarter numbers looked perfectly fine. Their earnings per share was right in line with what everyone expected, and their revenue was even a little bit better. If you just looked at these numbers, you'd think, hey, no problem here. But then came the guidance for the second quarter. And one single number changed the entire story. The stock plunged 13% after hours. Why? Because ServiceNow guided for an adjusted operating margin of 26.5%. The market was expecting over 30%. That is a huge miss, and it immediately set off alarm bells about their future profits.
And that weak guidance really tapped into a much deeper fear, which this analyst note from Deutsche Bank captures perfectly. The big worry here is that these big traditional software companies like ServiceNow just aren't moving fast enough on their own AI development. The market is getting nervous that if they can't create real, new revenue from AI, they're going to get steamrolled by newer, nimbler competitors that were born in the AI era. So let's zoom out a bit from just ServiceNow and look at the whole software space, which we can track with the ETF ticker IGV. You'll see how ServiceNow's bad news really put a damper on things. But then we'll contrast that with the incredible strength we're seeing from one of the giants of the sector, Microsoft.
So the software ETF, IGV, was right on the verge of a major technical breakout. It ran right up to this key price level, around $89.10, which traders call a resistance level. You can basically think of it like a ceiling. But after that news from ServiceNow, it just couldn't punch through and hold. And that failure has really slammed the brakes on the whole sector's momentum, at least for now.
But while the broader software sector was hitting a wall, Microsoft wasn't just knocking on the door, it blew right through its own ceiling. It made a really decisive move above its own key resistance level at $430. Now, for technical analysts, this isn't just a one-day thing. They see this as a potential long-term structural shift, suggesting the stock is moving out of a downtrend and into a brand new uptrend.
So what's the outlook for Microsoft from here? Well, long-term, this breakout looks incredibly positive. But in the short term, the stock has run up really fast, what we'd call an overbought condition. That suggests it probably needs to cool off a bit, to pull back. Analysts are eyeing the zone between $410 and $421 as a potential spot where it might find support. Catch its breath before it makes its next move higher.
And it's not just Microsoft. There are several other big tech leaders that are also flexing their muscles. Let's do a quick rundown of a few other key stocks that are trading right near their all-time highs, which is a really strong sign of momentum.
Now, check this out. With AMD, there is this fascinating and absolutely massive disagreement about where it's headed. The company's own management team is out there forecasting they'll earn $20 a share by 2028. If they do that, it could justify a stock price around $700. But Wall Street? The analyst consensus is way more skeptical. They're only forecasting about $10 a share, which points to a price closer to $356. That huge gap between what the company believes and what the market believes, well, that's the whole story for this stock.
Meanwhile, you've got Amazon just quietly chugging along, hitting a new record closing high. And Google is right there with it, getting very close to its own all-time high. Google's recent push past the $325 level was powered by some big news, the launch of their new Tensor Processing Unit, or TPU. That's their own custom-designed chip for AI, and in the race to build the best AI hardware, that's a really big deal.
Okay, let's bring this all home. We started this whole conversation by talking about a disconnected market. And after digging into all these individual company stories, the big overarching question is still hanging out there. Where does the market go from here?
And here we are, right back where we started. None of these big disconnects have gone away. Oil is still high, but stocks are shrugging it off. Bonds are still wandering aimlessly. It really is like every corner of the market is telling its own completely different story. And that lack of a single, coherent narrative is what's defining this moment in time.
A good way to describe this environment might be short-term chaos. It's a market where the big macro story, the economy, interest rates, just doesn't seem to be the main driver. Instead, every asset is moving on its own little catalyst. It's an earnings report for this stock, a geopolitical headline for oil. The normal connections have, for the time being, broken down.
And that leaves us with the one final critical question. This kind of divergence, it just doesn't feel like it can last forever. So the key thing we all have to watch is this. How long can all these different parts of the market keep telling their own separate stories before one single powerful trend finally emerges and forces everybody onto the same page?